Welcome, everybody, to the Daniel Coogan Associates market update for April 2024. We're going to be talking a little bit about the markets and get a little deeper dive into the bond market today. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Coogan Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me today.
All right. We're going to make this one quick, right, Rock?
It depends on our guest speakers.
Guest speakers. We do have guest speakers today. We got two of them. All right. So I guess we should get started, right?
Yeah, let's talk about the market. So who are you bringing up for that?
Oh, yeah. Kezia Samual. If you've heard her speak before, she really kind of cuts to the chase and gives you a good understanding of what's going on with the markets. So it's a small clip. And let's go ahead and run that clip for the folks.
Welcome to the first quarter of 2024's market update. I'm Kezia Samual, Deputy Chief Investment Strategist. Stocks sprang to new highs on strong economic data as well as strong corporate profits, while bonds modestly retreated as interest rates rose when investors had to pare back the expectations on how many interest rate cuts they were likely going to get in 2024. Broad commodities also gained on the heels of higher oil prices as well as higher gold prices. Lastly, interest rate sensitive investments like REITs suffered and fell. Within the equity complex around the globe, it was the U.S. markets that once again led the charge with a gain of 10.6%, marking 22 new record highs and its best quarter since 2019. However, unlike 2023, the market rally broadened in 2024. In 2023, there was a handful of stocks, the Magnificent Seven, that were tied to artificial intelligence and drove 60% of the S&P 500's 2023 annual gains of 26%. However, in 2024, the Magnificent Seven only contributed 41%, while the remainder 493 stocks contributed nearly 60%. Now, U.S. markets were not the only ones making record highs. Both Japanese stocks as well as European stocks also made record highs as we saw better than expected inflation data, a weaker yen, and strong corporate governance coming from Japan, taking the broad developed international region up 5.9%. On the other hand, we saw emerging markets once again lag the bunch with a gain of 2.4%, as strong gains in Taiwan, Korea, and India were not sufficient to offset the losses we saw in China. Now, looking at the bonds segment, interest rate sensitive segments suffered losses. Again, as that interest rate rose, we saw U.S. bonds drop 0.8%, while lower quality bonds that have less interest rate sensitivity, such as high yield, had a strong quarter with gains of 1.5%. Thank you for listening, and we hope you had a great week.
So the first quarter actually has come out pretty good, and I'm sure most of our clients are looking at their portfolios and saying, wow, that was a relief, coming off of a pretty decent 2023. Mm-hmm. So, our next speaker that we're going to have on here is Charles Luke from City National Rochdale. And this is kind of interesting. It's a little bit longer, but I think like 5.5 minutes. So let's go ahead and bring that clip up and take a look at what he has to say.
Hello, I'm Charles Luke, Deputy Chief Investment Officer at City National Rochdale, and welcome to my new Fixed Income Perspectives video series. Each month, I'll be discussing the macro trends and market dynamics that are impacting interest rates and the return potential across the bond market. So I'd like to start this new series with a question that nearly all investors have been asking, and that's, has the attractiveness of the bond market improved, and what is the right level of interest rates? And if we back up to 50,000 feet, yields have not been this high since August of 2009. And history is easily forgotten, but at the end of 2020, corporate bond yields reached an all-time low of 1.7%. Today's current level, around 5.5% for a corporate bond, is more than a 300% increase in yield. And as you can see from the current chart, the 10-year Treasury got extremely low after the pandemic and has climbed significantly. Aside from yield, the quality of the bond market's on solid footing. Borrower fundamentals are strong, profitability is improving, economic activity is above trend, and yields more than offset the current levels of inflation. And we believe that the yields and the underlying strength in the bond market will have two key outcomes on portfolios. First, our return assumptions have increased across all sectors of the bond market. And what that means is the contribution to portfolio return coming from bonds will be higher than what investors grew accustomed to over the past 15 years. And second, we expect higher yields to dampen volatility. After years of disappointing investors, there's evidence to suggest that bonds are much better positioned now to minimize volatility with the potential to stabilize portfolio values. But questions do remain with respect to which bonds to buy, and the potential for interest rate cuts has certainly fueled debate on whether to continue to take advantage of cash and short-term maturities, or to shift the portfolio into longer-term bonds to lock in the current level of interest rates. So all roads lead back to understanding where exactly the 10-year Treasury yield should be. And our view for some time has been a higher for longer environment for interest rates. While this view has been challenged over the past 18 months, we firmly believe that rates above 4% are here to stay over 2024 and are likely to drift between a range of about 4 to 4.5%. And let's discuss the three core reasons why. So price pressures are still in the system. As you'll see from this chart, which refers to CPI surprising above expectations, both the consumer price inflation, or CPI, and that's what you and I pay for goods and services we use, and the producer price inflation, or PPI, that's the price companies pay to provide goods and services to us. Both measures came in above expectations and well above the run rates that we saw last year in December. This signals to us an upside risk to inflation, and that will keep yields elevated. We're also observing price pressures from a tight job market, and that's still pushing wages higher than trend. Wages are key to downstream inflation due to the health of consumers. If wages continue growing at these rates, it's hard to see inflation declining rapidly. The second component is that the market has unwound expectations for Federal Reserve interest rate cuts in 2024. At one point, the market for Fed funds was pricing in 7 interest rate cuts. But based on the data in the first quarter, these aggressive expectations have shifted to align with the Fed's forecast of just 2 to 3 cuts this year, and we agree. Fewer cuts imply the economy remains on solid footing and rates should stay high. And last, the probability of a recession in 2024 has decreased, and that signals that a soft landing is possible. If this occurs and growth stays positive, it will continue to lower the appetite for conservative portfolio positioning. And practically, this means that flows into riskier assets such as stocks and high yield bonds are likely to continue, and we think that will set a floor on yields around 4%. Now, there are also signs that the volatility investors have experienced across markets over the past 2 years is starting to decline. On the current chart, you can see the VIX index for equities and the MOVE index for treasuries, which both are measures of volatility. And they've both declined this year from elevated levels over 2022 and 2023. Calmer markets will bring more stability to interest rates. And this brings us back to our core outlook. What are our recommendations? What should you be buying? And we prefer to take risk in corporate bonds as opposed to US Treasury securities. Given the higher for longer environment and the strong fundamentals, this gives investors the potential to maximize income and to leverage the defensive characteristics of corporate credit based on higher yields. For investors in high tax states like California and New York, the municipal bond market is currently offering exceptional value. And where possible, we're also positioning portfolios with an average maturity of 5 years. You may have heard this referred to as intermediate maturities. This will help investors to keep portfolio yields high over the longer term and avoid lower cash returns if the Fed does cut interest rates. History shows us that buying long-term maturities before short-term rates start to fall is a better approach than holding on to cash. And while we certainly acknowledge that risks do remain, the future is the brightest it's been for fixed income returns in a very long time. This is Charles Luke. Thank you so much for spending a few minutes with me this month. I look forward to seeing you again next month with our fixed income update. Take care.
So that was an awful lot, Rocky, in a short period of time, actually.
Yep.
So, many investors would say, man, from a bond side, it just has not been performing. But really what Charles Luke is saying is that we should be able to see some total returns that look a little bit better, that are palatable for people.
I think one of the points he made is that the bond market is a good value. When you say value, that means it's cheap,
Yeah.
not necessarily mean that it's performing right now. But what we're seeing is that if interest rates start to cut, and this is another point he made, if they start cutting interest rates, it'll be too late to buy into the longer maturities because they'll already go up really fast in price.
Right.
So they're believing it's time now to start positioning out of cash into those bonds in
Got it.
anticipation of what's coming in the next 3 to 6 months.
Well, that sounds like opportunity. And you know
Yeah.
me, I like opportunity. Well, that pretty much brings us to an end, doesn't it?
Yeah. Just one more comment I want to say on the equity side with what Kezia was pointing out is that what we saw in 2023 was basically the Magnificent Seven
Yeah.
carrying the market. But if you notice, if you remember her slide, she said 66% of the return this year has been in the 493,
Right.
not the 500. So it's showing that the market is broadening and that returns are, going more across the board. And that's a good thing long-term for investors, especially both of these, I feel, play into the more conservative investor. If you can start getting
Yeah.
returns out of a broader market, that brings in the dividend paying companies, it brings into your bond market,
Yeah.
given a good return, which helps the more conservative investor because they have a higher percentage of those kind of components in their asset allocation.
True. So that's again, that just breeds opportunity coming through this year. We don't exactly know how the markets are going to play out between now and at the end of the year. We believe that it's going to be positive at the end of the year, even though it could be a little volatile in between. But again, volatility can breed opportunity as well. So we're ready for this. And if you would like to hear a little bit more about how we view things, you can go to our YouTube channel at Daniel Krugen Associates, and you will find all the videos you want. So you take care of your family, and we'll take care of you, and you just have a great day.
Good to see everybody. Have a good day. Why don't we start it over? It's not that difficult. We're only a minute into it. So
I had everything all ready to go. Everything. For the record.